Team, welcome to Introduction to Accounting. I suggest taking this lesson up in parts, taking up to a maximum of 8 to 10 slides per sitting. If you have the opportunity to see the movie Dave, starring award-winning actor Kevin Kline acting as the U.S. President, there is a hilarious scene wherein the President invites his personal friend, an accountant, to fix the budget to be able to reinstate the First Lady's project for homeless children. The 5-minute scene gives us a flavor of accounting's role in business evaluation, communication, and decisions. In this chapter, we will learn the accounting terms we will be using in class. Accounting is the language of business. It is a snapshot of a company's investing and financing activities. It is a way to communicate the firm's results externally, an objective basis for business decisions, and a means to evaluate the company's performance. Accounting is governed by FASB, or Financial Accounting Standards Board in the United States, and IASB, or International Accounting Standards Board, as well as IFRS, or International Financial Reporting Standards Foundation internationally. The first type of financial statement we will take up in class is the balance sheet, which is a statement of the company's financial condition as of a certain date. It consists of assets, liabilities, and shareholders' equity. So intuitively, what are Kate Moss's assets? Her face, figure, attitude, etc. What does she do with those assets? She uses them to generate her income. That is similar to assets in business. That is, assets are the company's resources used to generate profits. Generally, following constitute assets: cash and marketable securities, accounts receivable, inventory, prepaid expenses, plant, property, and equipment, investments, goodwill, and intangibles. See Tapestry's assets in this slide. Current assets are short-term and expected to be converted to cash or profits within 1 year. They also represent the core business of the company. The first 4 assets, cash and marketable securities, accounts receivable, inventory, and prepaid expenses, in slide 5 are current assets. For example, this slide shows images of Tapestry's current assets consisting of Kate Spade handbag and accessories inventory. Let's focus on accounts receivable, which is created when a company sells its goods and/or services, but has not yet received payment from the buyer. In effect, it is temporarily funding the buyer until the latter pays for the goods it bought. When the buyer pays, accounts receivable decreases. For example, J. Crew in New York sells sweaters to the Robinson family visiting from Switzerland, which pays via credit card. In this case, J. Crew in New York has allowed the Robinson family to take the sweaters home and has recorded a sale, but has not yet received the cash payment. In a few days, the credit card company or bank will reimburse J. Crew, representing cash payment or settlement of the transaction. At that time, accounts receivable will be reversed or reduced. In case 2, Jones Apparel in New York sells suits to Eaton in Montreal on 30-day terms. In this example, Jones Apparel has delivered the suits to Eaton, but has not yet received cash payment for them. On or before 30 days from the sale date, Ethan will pay Jones Apparel for the suits by sending or remitting funds to Jones Apparel's account with Citibank. In this instance, the transaction is merely payment or settlement of the sale made approximately 30 days ago, in example 2. Therefore, Jones Apparel simply verifies to ensure it received the payment and reverses or reduces accounts receivable because cash was received. Non-current assets are long-term and expected to be converted to cash at least after 1 year. They also represent the non-core business of the company. The last 3 assets, plant, property, and equipment, investments, goodwill, and intangibles, are non-current assets. For example, Nordstrom's properties pictured in this slide are expected to be held for longer than 1 year. Liabilities are the creditors or suppliers or lenders' claims on the company or the portion of the assets funded by non-owners of the company. They consist of accounts payable, overdraft, short-term loans or debt, as well as long-term loans or debt. See Tapestry's liabilities in this slide. Current liabilities are short-term amounts owed by the company and expected to be paid within 1 year. The first 3 items in slide 13 consist of current liabilities. For example, the amount owed by Kate Spade to its suppliers as represented by accounts payable. Accounts payable is created when a company buys goods and or services but has not yet paid the seller or supplier for them. Accounts payable is reduced when the company or buyer pays the supplier or seller. Tiffany's in New York buys diamonds from De Beers in South Africa on 60-day terms. In this case, De Beers is delivering the diamonds to Tiffany's, and Tiffany's has recorded the purchase but has not yet paid for them. That is, cash is payable within 60 days. On or before 60 days from the purchase date, Tiffany's will pay De Beers for the diamonds. In this example, the transaction is merely payment or settlement of the purchase made approximately 60 days ago. Therefore, Tiffany's simply pays the funds and does not need to record the purchase because that was done 60 days ago. Once it pays, the company will reverse or reduce accounts payable. Non-current liabilities are long-term amounts owed by the company and expected to be paid at least after 1 year. Shareholders' equity is the owner's claim on the company's assets, including funds invested by shareholders and earnings realized by the company not distributed to shareholders through dividends. They include common stock, or the par value of the common stock, additional paid in capital, or the amount paid in excess of the par value, and retained earnings. See Tapestry's shareholders' equity accounts. So, what is the relationship among assets, liabilities, and shareholders' equity? Assets equals liabilities plus shareholders' equity, or investing equals financing. This means that to invest in assets, a company must finance it either through borrowings or equity. A project or investment needs financing in order for the project or investment to go through. Keep this in mind as we learn and apply lessons to higher level use in the succeeding learning units. An income statement is a record of the company's operating and non-operating activities for a given period, be it monthly, quarterly, semi-annually, or annually. Simply put, it is a statement of profit and loss. See Tapestry's income statement. Revenues include sales and other income such as interest. Expenses include cost of goods sold or cost of sales, marketing and general administrative expenses, as well as interest. Revenues less cost of sales equals gross profit or loss. Gross profit less sales, marketing, and administrative expenses equals operating profit or loss. Operating profit less interest expense equals net profit before tax. Net profit before tax less tax equals net profit after tax. So what is the relationship among revenues, expenses, and net income? Revenues less expenses equal net income. Now, recall our lesson in Chapter 1 that the main goal of a company is to build shareholder value that can partly be accomplished by maximizing profits. In order to accomplish that, what do we need to do to revenues and expenses? Increase revenues and decrease expenses. Remember this as we apply these lessons to higher level skills in future learning units. Now proceed to the accounting exercises to apply our lessons.